There you go.
Okay, can you hear me now?
Yes.
Okay.
Yes.
Okay, so I was just saying housekeeping stuff. First part, this is recorded. The transcript will be posted online once we're done. The second portion is that we might have some people from the public. If you want to comment, just please announce yourself, and if you represent somebody who you represent, and then we'll you can comment. Okay, now to the substantive part of this. The purpose of this meeting is to invite all interested parties to discuss the topics raised in our Bulletin 2025-04, and hopefully start a conversation with finding some collaboration and some ways to move forward and to resolve any uncertainties or any gaps that we've posted on the Bulletin. Hopefully all of you have read the Bulletin, but we, just to summarize it, the Bulletin addressed two statutory frameworks: the consumer lender framework and the sales finance framework. And the department explained how, through observations of examination and otherwise, we've seen some potential gaps, I guess, in the law where there might be some overlap and there is not a clear definitive line of which framework applies to certain conduct. And in the case of companies engaging maybe in perhaps conduct that could trigger two frameworks, what is the law supposed to? What is the law tell us to do in that case? Under the current laws, consumer lenders are not directly exempted from the sales finance laws. And if a consumer lender engages in some sort of conduct that might trigger the sales finance, we believe that there is not this certainty in the law to direct us in what we need to do. And I think that is why we need to find some ways to just create a playing level field so anybody understands what they need to do when they come to do business in Arizona. The department issued the bulletin initially just to address that and just sort of raise that issue to the public and to the regulated industry. First, we asked for some comments, and we received 3 comments from 3 parties, which are actually on the agenda today. After receiving the comments, we actually we found some areas that actually 3 parties agree on. For example, modernizing the consumer lender laws. I think everybody agrees on that. So maybe that's why we think this is going to be a very productive conversation. But then now, after receiving the comments, we are again inviting all the interested parties to just sort of, again, chime in, explain what possible solutions there could be, or whatever you guys want to discuss in this open forum, and hopefully we find some areas that we can move forward from. Just wanted to obviously give the caveat: DIFI is an enforcement agency. We cannot engage, we don't engage in lawmaking. So any comments from us will be sort of the department can be involved, but we don't write the law. Again, just sort of the department will try to give you some substantive feedback here. But at the end of the day, I think we've pointed out what the issues we believe are in the current structure. So hopefully the whole industry and anybody else interested could point us, and we could together move towards a permanent solution of this. And I think that's the important part here is, at the end of the day, the law is open to interpretation, but at the end of the day, if people believe there's ambiguities, that leaves the spaces of people to create different interpretation. So I think anybody agrees here that there should be this permanent solution so that there's no questions about it, and we don't end up in situations where people might disagree with the reading. So I think that's ultimately the goal here, and hopefully we get there. Okay, I think that's it. If there's any questions, maybe always feel free to ask, but the next part will be to go into the actual presentation as the agenda. Any volunteers who wants to go first? If not, we can just follow the agenda's order.
Yeah, I thought the agenda was the 2 vendors were going to do all that.
Would you kind of?
Yeah, I think sure. Yeah.
I mean, Mr. Dalton. I'm pretty sure I'm not first.
That's I read the PowerPoint yet, anyways.
Yeah.
So you're fine. All right. Well, thank you. Good morning, and thank you, department, for being this long important discussion. My name is Sonia Galati. I'm an assistant vice president at Landmark Financial Services, and I appreciate the opportunity to speak with you all today. So I've personally been with Landmark for about 8 years now, and I began my career in financial operations. And from 2020 through 2022, I actually led our entire Arizona market, 8 branches here. And in that time, it provided me with a close and real world view of the financial challenges that families do face and the importance of a clear, stable consumer protection framework. So Landmark, in a nutshell, is a community-based, non-depository installment lender. We operate, again, 8 branches across Arizona and serve thousands of families every year. Our customers are everyday, hardworking Arizonans, teachers, healthcare workers, tradespeople, service workers, and like all of us, they do experience life events where a financial need arises. These moments can include unexpected expenses such as a car repair, medical bill, or home emergency, but it can also be more routine or forward-looking needs like relocating for work, investing in education, or certification, and making necessary household improvements. Across these circumstances, the common thread is that real and legitimate financial needs exist at different points in consumers' lives. So every person faces a moment where access to credit plays a role in keeping their financial life moving forward. Our goal is to be there with a transparent, fixed-term product they can succeed with. Key principle of our model that I really want to hone in on is that our business only succeeds when our customers succeed. We cannot succeed if our customers cannot succeed with their loan. Installment lending depends on predictable, steady repayment, and that can only happen when a borrower can comfortably afford the loan. Title VI already embeds strong safeguards, fixed payments, full amortization, ability to prepay underwriting, clear disclosures, and direct regulatory oversight. One area of Arizona statute that I feel we all agree on deserves some thoughtful attention. The $10,000 consumer loan definition was set in 1980. I'm so sorry. In today's dollars, that's approximately $34,000. Many common responsible financial needs now exceed that amount. If you know a used car, you're not going to find one for $10,000. Not because consumers have changed, but because the economy around them has. Modernizing this limit expands protection and not risk. It allows more Arizona families to remain within Title VI, where the strongest consumer safeguards already exist. It ensures borrowers aren't pushed into less suitable or less transparent products simply because their needs surpass this decade's-old number. This modernization is not about expanding products. To be very clear about that. It is about expanding access to the protections that already work. Across those 8 branches, Landmark manages about 90,000 interactions annually. That's customer payments, customer service, loan closings, all of that. Out of those, we have 1 out of 10,000 escalations, complaints of any sort, official or just calling our department or our company and saying, hey, we didn't like how this was done. 1 out of 10,000. I feel like that really does reflect consistency, transparency, and the value of our in-person community-based model. So this approach reflects the principle articulated by Richard Cordray, former CFPB director, who noted that the credit markets work best when there's a beneficial alignment of interest between borrowers and lenders. When regulatory frameworks support that alignment, consumers are better protected, access to credit is preserved, and lenders are incentivized to operate responsibly and sustainably. That alignment already exists under Title VI, and that's why we feel like this framework has worked effectively for so long. Landmark believes Arizona can maintain a strong consumer protection environment while also ensuring that families have access to responsible, sustainable credit options. We support strong, clear regulation. We support modernizing outdated statutory thresholds, and we support expanding access to safe installment credit within that Title VI framework. We want more Arizona families to stay within protections that work, and we're committed to collaborating with DIFI, lawmakers, consumer advocates, and all other stakeholders as this conversation continues. And we really appreciate the time to speak on this today and have this discussion. We did do a little bit of a PowerPoint. I won't go too deep into the weeds there. It's kind of reiterating what I've spoken to here, but just a little bit of a visual. Just a second.
Sharon, just let me bring it up.
No problem. All right. We skip over to the first context page for me. I'll skip over the agenda here and just go through this. So a little bit about who we are. So again, as I mentioned, we're founded in 1996. We're in 23 states currently, and we serve over 500,000 customers annually. That's just a little bit of a map so you can see where we are geographically across the country and just a visual of what our branches really look like in the communities. You can go ahead and look forward for me. So in Arizona, again, those are our 8 branches. We have 3 in Tucson, 5 in the Phoenix area, Glendale, Gilbert, Surprise, Mesa, Phoenix. And during our time here, we've lent over $50 million to Arizona families, again, just to support things such as transportation, medical costs. And again, I was here during COVID, so I really saw the needs of the Arizona communities during that time as well. So again, our footprint here reflects a long-term stable commitment to serving Arizona responsibly. Go ahead and cover for me. So again, just a little bit about who we serve. I mentioned they're just everyday Arizonans, teachers, healthcare workers, hospital employees. So the needs, like I mentioned before, arise for all consumers at some point. Our role, once again, is to provide a clear, affordable, structured loan that does help them stay stable. We're not here to put them in a loan that they can't afford. I'll go ahead and go over there. All right, so again, we won't go bullet by bullet here, but just again, focusing on our model and why it does, again, speak to consumer success, why we've set it up this way to make sure that the consumer has everything they need throughout the life of the loan, especially that in-branch partnership with the branch members. All right, so again here, I want to focus in on title number 4 here. So I think that's the biggest key point here again. Title 6 provides those important guardrails that make the model we operate under both effective and beneficial to both the consumers and to the industry. Our business only succeeds, again, when our customers succeed, and our structure is intentionally designed to make that possible. All right, this is more of just like economic background. We've already discussed it. We know the limit was set a while ago. I just want to put it out there. Again, it's over $30,000, about $34,600 in today's dollars. Household needs have increased, but again, those definitions have remained fixed. Modernizing outdated language is a consumer protection measure. Doing that is providing protection for our consumers. And again, prevents families from being pushed into other options that may not be properly structured for their needs. All right, so again, this is speaking to that escalation complaint number I mentioned before. Again, 90,000 annually. That's a huge amount of interactions we're doing every single day. Hardship management, anything that they could possibly need. And out of all of those, in the last 3 years, we've averaged again 1 in every 10,000, which again, a complaint rate this low over this many interactions does reinforce that the current framework works for consumers. Community presence, those are actually 2 of our local offices. That is our Glendale office and our Surprise office. I want to just get a visual out here of like where we are in the community. Again, when I was here, our customers are in our community. We live in the same communities. We go to the same grocery stores. This is a relationship-based lending model. Borrowing money is a very intimate, very sensitive thing, and we want to make sure we're there to support our customers across every step of that process. And then really just our final core commitments. We support for regulations that promote the beneficial alignment, as I mentioned before, support for modernizing the statutes to meet the 21st century needs, and support for expanding market access to Arizona's consumer finance law, specifically under Title VI. And we are strongly committed to working collaboratively with DIFI, with the consumer advocates, with our peers, and all the state policymakers as we move forward in this. And just as a closing, we're here as partners aligned with your goal of ensuring safe, affordable, and well-regulated access to credit for Arizona families. Thank you.
Just a quick question, and I don't know, not to put you on the spot, but I think there's this notion of everybody keeps saying Title VI has better protections than Title 44 self-finance. I think obviously one of them being perhaps is that sliding scale of the finance charge. Anything else, just so any other better protections, I guess, under Title VI?
I am aware that the cap under Title 44 is 120%. So I think that's key. We don't even want that extension there for us. Like, again, we feel like that's one of the categories, but also the different, I believe under Title 44, there's different products that can or cannot be offered. So speaking to that as well.
Having a clear line and distinction between the 2 products, I think, is the most important to the association.
And could you, what association again, Kelsey?
The Arizona Association of Financial Services.
Okay.
No.
You let them go first and sit in the room, but Ashlyn, I believe you're presenting for One Main Financial?
Yes, can you guys hear me okay?
Yes, we do. And do you have a presentation or you
No,
you should be able to share your screen if you have.
Just some remarks, if that works.
Okay, go ahead.
Okay, awesome. Well, first of all, thank you to all the stakeholders who are here today to discuss Bulletin 2025-04 and the importance of access to credit in Arizona. My name is Ashlyn Teal, and I am a Vice President of Public Policy at One Main Financial. We're a public traded company that's been lending to Arizonans for nearly 60 years, and we currently operate in 47 states. We really appreciate the department providing the safe harbor for the sales finance company license for relevant loans over 10,000. We believe this pause allows stakeholders to find a collaborative solution that protects consumers while also continuing to allow Arizonans to have access to good and safe credit products. So a little bit about One Main in Arizona. We currently operate 21 in-state branches with around 100 employees. And then we also have a central site in Tempe, and we have about 350 employees, a little over that at that central site. We're currently serving over 50,000 Arizonans with the extension of $533 million in credit. But we don't just open our branches at 9 a.m. and go home at 5 p.m. We are very integrated into our communities. So for example, in just 4 short years, One Main employees have volunteered in 96 Arizona high schools, bringing financial literacy courses focusing on subjects like what is your credit score and why should you care about it, to nearly 15,000 students across the state. To date, Arizona high school students have completed more than 20,000 hours of financial literacy courses offered in both English and Spanish by One Main. One Main loans are underwritten and extended with one single goal, that our customers can successfully repay the loan while also continuing to meet their other monthly obligations. The business model does not work if customers cannot meet their payment obligations. We'd also note that our customers are not new to credit or financial products. Additionally, we work with our customers if they do happen to run into a financial roadblock through our borrower's assistance program. We can provide the customer with temporary or permanent loan modifications until they're able to get back on track. We are also currently well regulated in the state of Arizona, and all of our loans are provided in routine examinations conducted by this department. We hold both the consumer lending license as well as a sales company finance license. I will say it's important to note that although we do hold the sales company finance license, we are not a title lender or a retail seller, and loans under both licenses are really consumer finance loans. Further, while the sales company finance license, as Sonia was talking about earlier, allows for much higher interest rates, we as One Main continue to self-cap at 36%. To that end, we believe that there is likely a better solution than holding 2 separate licenses for similarly structured loans. We believe that further engagement and discussion is needed, though, to determine whether there should be changes to Title VI or changes to the sales company finance license and what those changes entail. I think we all can agree that the path forward must always place the customer first. And in our view, putting the customer first includes ensuring they can access credit when they need it most, and that credit is underwritten to fit a customer's budget to give them the highest chance of successfully repaying the loan. As I mentioned earlier, we support a collaborative solution on the best way to regulate consumer loans in the state, but we also believe this will take time and perhaps more than one legislative session. And so for this reason, in our comment letter, we did request an extension of the safe harbor through the 2027 legislative session. However, we'd also greatly appreciate if the department would continue to be willing to work with us if more time is needed. Lastly, I'd like to thank the department for providing the forum for today's discussion. And I look forward to working with you guys as we continue to find the best path forward on regulating consumer finance loans in the state.
Last one, maybe continue or?
Just maybe one question. If we agree further discussion might be needed, from your guys' perspective, does that look with the department, with other agencies, maybe legislature, and what does that look for us? Meaning, how do we support and how do we keep engaging, given our limitations as an enforcement agency?
Yeah, I think both working with the department and perhaps I think looking at a more permanent solution involving the legislature in order to get more clarity in statute, I think is the way that we were viewing it.
Thank you.
Two other folks.
Okay. I'm Jamie Ratner. I am the current president of the Center for Economic Integrity, which is a nonprofit dedicated to minimizing economic oppression waged by industry and the government on people with few resources. A little bit of background. I'm pretty much retired now. I've been a law professor here at the University of Arizona since 1985. None of my remarks should be associated with the University of Arizona at all. My fields are antitrust, contracts, administrative law, so this is right in this area. Before that, I was a trial attorney at the United States Department of Justice Antitrust Division for about 5 years, where I developed an expertise in competition in regulated industries, and my practice was largely before administrative agencies, and mostly on the federal level and regulatory bodies. So I'm familiar with that. I say that only in part, so you will know I am not one of those that can't teach law professors, and I practiced and still keep up with that. But mostly I say it because some of what the center believes in our perspective is going to have that antitrust regulation bias, and that's what we are dealing with here. Is a rate regulated industry, but it's bifurcated. There is rate regulation with respect to consumer loans. There is alleged but not real rate regulation with respect to the car title loans, and then there is, interestingly, for the remaining loans, there's no usury laws in Arizona. It's unfortunate, very unfortunate as far as the center's perspective is. Okay, so our perspective is, with all respect, we don't think this is ambiguous. We think this law needs to be enforced. It's minimal protection for consumers, and it needs to be enforced as it is, including the $10,000 cap. And there is no room, basically, to go beyond that. I'll explain here for a bit. So briefly, some reminders of what I think everybody in the room knows, but it's important for us to say and important to focus on. Those consumer loans, defined by 10,000 is the max for a consumer loan, are regulated extensively by Arizona law. And there's 3 important aspects to that regulation. Lenders must obtain a specific license for consumer loans and adhere to those license requirements. There are interest rate and fee caps and term caps and a balloon ban for these loans. And the maximum amount is $10,000. And the purpose, as we know, is not to guarantee a comfortable source of money for lenders. It's to protect, as much as possible, vulnerable, low-resource, captive, unsophisticated prospective borrowers from economic abuse. Oppressive lending leading to inescapable cycles of debt and debt traps. And that's one area where we certainly agree with at least the people here who are speaking, which is, it doesn't do anybody any good if they are always under here. The question is, what's the best way to protect here? Each of these three aspects plays a crucial role in that regulation. The specific license indicates responsibility with respect to these kinds of vulnerable consumers, age monitoring that you do with respect to this particular kind of loan and for these borrowers, and compliance. And it also, you have a license and you advertise it, and you license and you doing consumer loans. Consumers are entitled to rely that it will be only a consumer loan, that's what the requirements are, and they can go in with a little bit of knowledge. There are also those rate and fee caps to minimize price abuse. Price competition, especially for consumer loans, price competition doesn't work here. So those caps are designed to curb abuses, situations where the people come in, for the most part, they're not price shopping, they are desperate in certain ways. It's almost like addict pricing. So you got what any economist would call a market failure. The normal market forces cannot work adequately when people are basically going to come in and they're going to do it if there's any way they can do it, rather than price shopping in any way, shape, or form. And this all goes along with what the CEI initiative a long time ago, where the voters were pretty strong in saying no payday loans. Let's get rid of all of that predatory type of lending. So these rate caps, that's for consumer loans. That's the same type of thing. And the third thing that, and I understand the perspective about 10,000, but that 10,000 cap is in there for a reason. For one, it defines this particular market for regulation. And we can talk about maybe if the market needs to include larger loans, but larger than $10,000 loan is different. We're talking about different people seeking different amounts of money, and that $10,000 defines this market. It approximates the people who are most likely to need the protections offered by consumer loans. And combined with the rate caps, it maximizes the amount that lenders can take from these particular vulnerable consumers. So it minimizes, and that's really the way this regulation works. It minimizes the total dollars that the industry can take from consumer borrowers. And yeah, it's a little parentalistic, but it is saying, let's try and keep the total amount of the loan down, as well as the amounts of rates that can be taken from the lenders on this. That's the way this regulation works. And it is noteworthy to point out that as the loan increases within the consumer loan protection, the rate cap drops. So, okay, at first, if you're talking about a smaller amount, then you're allowed a higher interest rate. As soon as you get to larger loans within that 10,000, then enough, industry, don't take more than a maximum amount of dollars. There's no benefit, and an economist will tell you, there's no economic benefit that comes with a higher interest rate. There may be an economic benefit that comes associated with making a loan when otherwise somebody wouldn't have that money. But if you're just talking about a higher rate as compared to a lower rate, that's all just distributional transfer away from these vulnerable consumers to the industry. And that is what this regulation is designed to minimize. We'll say one other thing about it. One unfortunate aspect of any rate regulation, price caps or otherwise, when it's a cap, and especially here where borrowers are vulnerable and essentially captive and there isn't much price competition going on, is that unless the caps are at a sufficiently low basis, you're going to end up almost guaranteeing too high a rate of return to the people who are being regulated. Price competition can theoretically in a cap situation force prices down to the competitive level where you have only the efficient lenders in there and lenders are only making a normal rate of return. But if you don't have price competition, you don't hear what happens, and this is not restrictive of this industry, it happens all the time. The cap becomes the price that everybody gravitates around, and maybe there's a little movement off of that cap, but it's a phenomenon in antitrust known as the max becomes the min, and it is why it is a per se illegal violation to fix maximum prices just as much as minimum prices. And what happens in this industry is you gravitate, those prices will gravitate toward the cap. It gravitates at that high amount, and you don't see what you really should see, which is downward competition. It's not forced by these consumers. They're not sophisticated enough. They're too desperate. That's the worry. And so that's the problem with that. In addition, another giveaway about that is caps don't respond to interest rates. As the Fed drops the interest rates in a normal market situation will go down. And they don't. There's no evidence that they do in this market. So where these consumers can't effectively price shop, and given this particular kind of market failure, the best way actually to find the most efficient levels and get to what I would think of as a competitive price from this industry is actually set the caps way, way lower. And then you will find people who can make a normal rate of return lending. These caps are high, and in Arizona, the stated caps are 36 for the first 3,000. Yeah, but when you add in fees on a percentage basis, the actual capped rates are for a $500 loan are 54%, for a $2,000 loan they're 41%, and for a $10,000 loan they are 30%. Our position is that and many states, and it's in our material, many states that have regulated consumer loans recognize this and have considerably lower caps. So if you're looking to amend, we need lower caps to get something closer to the competitive level here, because it's not happening right now, and eliminate the fees and prohibit things that now are allowed that are really low value, such as life insurance or credit insurance or disability insurance. Those two, and I didn't even add those in the percentages there, those two inflate an actual amount that is going from consumer to the lender. And that would be the way to get a genuine competitive price. We need to get closer to a competitive price, because competition does protect consumers. It keeps it with the consumer instead of the producer skimming off each one, and that's not going on here. But in fact, I think that's discussion for another time about amending. Under the current laws, I read it pretty closely here. I don't think the department has any power to change the cap levels or change that maximum. That $10,000 maximum is an essential part of this regulation. They go together. So, and this is what I think of as minimally protective statutory regulation, and the $10,000 keeps the amounts down here. It keeps consumers from getting too much in debt. And I don't think there is any way around this law. You're not permitted under the current law to use a consumer lending license to take more money from a consumer. And consumers need to know that limit. They need to know you can't borrow more than $10,000 if you're coming in. It can't be that you get in there and so, well, there's going to be some more here. That's still at a very, very generous rate for the lender, even if you adhere to the consumer lending protection. Even if you blend it, it's still going to be what is still going to be close. If it's 30% for $10,000 loans, it's going to be 28 or 27 or 20. It's still not a good deal for the consumer. Last comment on this is that I looked through this and I think there's a good argument that if a consumer lender now knowingly lends more than $10,000, that's probably in violation of the statute, and it probably, there's a good argument it invalidates that loan, at least is the way I read the statute, at least to the extent of all of the finance charges with respect to that, because it's knowingly entering into a loan for a greater amount than the statute and all of its regulations allow. And the department, as far as I can see, doesn't have any ability to waive that. That would be a civil action that somebody brings in response to that loan. And I think the lenders need to think very seriously about that. Okay. These are larger loans. If it's a different market, and I'm really receptive to hearing and thinking about that, but it still has many of the same problems as the 10,000 and below loans, then these consumers are going to need comparable protection too. And in the states that regulate loans higher than $10,000, most of them have a rate cap which is even lower than the basic consumer rate loan. So the center's position, and that is thinking to the future, if there's going to be amendment, then it's a non-starter for amounts over $10,000 unless there is an even lower cap for that. So the consumer loans need to be lower, and this would even need to be lower than that. At this point, I don't know that this should be something the department should be trying to encourage here. And I'll say one more thing about this, and then briefly go to the title loans. I don't think it is okay. I don't know about this safe harbor. It's no justification to say, well, we need some time to lobby the legislature. Let's run through this in a different example. Let me continue to illegally distribute this fentanyl while I lobby the government to grant me a license. So let me do it now, because I'm going to try and get the law changed so then it is okay. I don't think this law is ambiguous. I think it's capped at $10,000, and that is where it needs to stay.
I don't want to interrupt you, but just to stay on that, I want to make sure you understand the position, because, and I think historically, but our regulatory framework defines consumer loan as 10,000 rights.
Right.
And there is a Title 602 exemption that says loans over 10,000 are not regulated. So is your position, I guess, and I don't want to engage in like statutory interpretation, is the position that loans over 10,000 are prohibited or exempt?
They're prohibited by, if done by a lender in a framework of it being a consumer loan. So if you have a consumer loan license and you hold yourself out to consumers as making consumer loans, you can't also in that same house, in that same place, offer loans over $10,000. You have to choose. That's the only way that this regulation makes any sense at all. Otherwise, you go in thinking you're getting a consumer loan, and then you got somebody else who's trying to tell you something else. I'll go to the other part, and I think maybe this will make that clear as well. Your other query was about whether a consumer lender should be permitted to also obtain a sales finance license and be able to make car loans in excess of $10,000. I'll wait on this here, but the answer to that is no. The center's position for a long time is that car title and registration loans are predatory lending, and we are totally willing to work with y'all on the idea of this is not the way to go. They're really just the same predatory as payday loans that have been eliminated. They trap consumers in continuing cycles of debt, and in addition, suggest they're going to lose their transportation that they need for jobs, that they need to get their kids to schools, and there's those triple-digit interest rates. The statutes currently define car title loans as not consumer loans, and this is just preposterous because that $10,000 is indicating the type of lender who is vulnerable, who may be in a difficult position, who needs these regulations. You can't say, oh, but that's not true for a title loan. It's preposterous. All the borrowers are going to be the same. They all need the consumer loan protections. So one thing to do if we are thinking about amendments or different laws is simply get rid of that and put all loans, 10,000 or less, under these basic protections. But pursuant to the Arizona statutes, then a licensed consumer lender can't make car title loans with their much higher rate caps at the same time. You're going to have to pick which are you going to do. You can't do it for the same business there. Fundamental, long-standing antitrust principles prohibit regulated firms or extensively regulated firms from also providing less regulated or non-regulated products here under the same roof. You can't offer both. The incentives to skirt the regulation are just obvious. Okay, I come in expecting a rate capped loan, and the next thing I know, hey, what you driving here? And you will be shoved over every single time into what is more lucrative for the lender. And it's going to make monitoring impossible. How are you going to be able to sort out what is doing what here? And if your goal is just do it for the $10,000 loans, how can you keep them doing it? You cannot keep them doing it. The standard antitrust description of this activity is regulatory evasion. And the same thing goes on with your previous question, which is if you have them doing both, they're in the same house, you have a 10,000 max rate capped, and then you have an unlimited, uncapped rate being sold to the same prospective borrowers. No, you cannot let a regulated lender who's doing consumer loans offer those. So our position is enforce the laws as they exist. It isn't that hard. Consumer lenders have to choose. If they want to do consumer loans, do them up to $10,000. If they want to give up on consumer loans and do regular loans, then in the wild west of Arizona, and we really strongly are headed in the direction of trying to get some usury law caps, but that's for the future. And car title lenders can do car title loans. Don't believe it's burdensome to lenders. Don't believe it is burdensome to consumers. There'll still be access for whatever kind of loan they wish to get. Thank you. Sorry if I went over my time.
I do want to go back to, again, I mean, from a statutory perspective, where the law says the requirement of the chapter does not apply to loans over 10,000. How can then the department come and say, we have the authority to prohibit you doing anything over 10,000? I see the authority is what the framework gives us power over.
You have authority to say to any consumer lender who's licensed, when you are selling consumer loans, they must be at $10,000. And if you are doing some other business over $10,000, can't do it in the same house here. That's regulatory evasion. You are seeking under the guise of holding and operating a consumer lending license, you are also operating in non-regulated ways. Have to keep them separate. That's the only way rate cap regulation makes any sense. If you're going to let people who hold themselves out as rate capped also do non-rate cap things, and I know the thing that's hardest here in a way is really but that $10,000 defines the market and is part of that regulation. You can't do loans over $10,000. Oh, well, I can do it because that's not regulated, but not what gives you the power about that is all of the consumer lending regulations, and you have to have a license specifically for that. And yeah, it's evasion. There's consumer confusion and there's evasion, and I mean, I come at it from an antitrust perspective. It's a no-brainer. You don't tell a regulated industry that they can also operate with the same prospective consumers in an unregulated market.
Now, I think we acknowledge that there's unregulated lending in the world happening, right? So in this case, if the department's position is that this exemption limits our ability to anything over 10,000, is there an agreement that anything over 10,000 that is potentially not regulated, the company should still be capped of the current consumer lender? Isn't that a benefit?
Well, no, it's not exactly a benefit for the reason I pointed out, which is because the cap, in fact, in the unregulated market, you do it alone. If competition works, those rates should be way lower than the capped rate. It's not clearly a benefit, and the statute is trying to say, no, you don't get in over your head more than $10,000, and the lenders are not entitled to make more off of consumer borrowers. So it's sort of I don't want to say it's a sort of a cosmetic appearing benefit. It's not really a benefit. All the places that regulate and say, no, these are intermediate loans, it's a different borrower than the consumer loan at $10,000, but they cap the rates at even lower than the consumer loans. So no, we don't think of it as a benefit. I respect it in a certain sense, and I understand, but that's way too high a cap.
In your opinion?
Well, that is, and I think that all of the states that recognize that, and in fact, it's more than just my opinion. That's the premise of the consumer lending part of it as well, because it starts out at 36%, which isn't a real 36% when you add on the fees, but then it drops it down to 24% for the higher amounts. So if you're going above, and plenty of states do this, then you have to drop it a little lower, or not.
Plenty of states
Yeah.
allow for 36% up to 10,000.
Yeah.
May I say just one?
Yeah, of course.
Just want to reiterate, don't want to get too far into the weeds here, but just again, that $10,000, I hear the argument, I hear all of this. I still want to just reiterate when that was established. I think that is imperative to also hone in on. I understand at the time it was established, it's hard to say, no one can say in this room that the dollar has not changed in value over the last 40 years, 45 years. I think that is clear, and that's not, it costs more. It costs more to get the same thing that cost $10,000 in 1980 than it does now. And I just want to leave it there. And again, just reiterate, we cannot, as a company, we are not set up to put any of our customers in a loan that they cannot successfully afford to pay back. That is just something I want to continue to say. They can't, it doesn't behoove us. On a $3,000 loan, 36-month term, it takes 24 on-time payments for us to get the principal even repaid on time, not late. We're not counting on them to be late. We want them to be successful in the repayment of the loan. And just to the interest rate point, our average rates, APR, inclusive fees, every product, anything that's included in our loans in Arizona is about 28%. So I just want to state those few things.
Can I just bring a point? Because I started by saying there's areas we agreed on. That was based on the comments. And I want to go back to your comment that you submitted originally. In the second point, I don't know if you want to bring it up, I can bring it up, but I think you guys were saying we're okay. You were saying the legislature should increase the 10,000, but now I'm hearing something else. Can we?
So that was a concern, and I had to try to be very brief in our comments so that it couldn't be misconstrued during the legislative session during testimony. And so I think what
Kelly,
he's talking
Sorry
about.
to interrupt you. Could you just state who you are?
My name is Kelly Griffith. I'm the executive director of the Center for Economic Integrity based in Tucson, Arizona. No problem. So if the question is about what the law and the statute says right now and what's happening, I think Jamie answered that question. The law is the law is the law is the law. However you want to nuance it, it's still the law. And the law was for a reason. And I hear what you're saying. And so we've been down this road before and had legislative conversations. Kelsey and I have. And the bottom line is the higher the loan amount, the lower the rate. And that's just common sense and ethical common sense, if you will. And so that's really what we're saying. And we're also saying that the law is a law is a law. So where we are now, this is what the law says, and the law needs to be enforced. We're saying, yes, car title lending interest rates are unconscionable. 120 to 204% APRs, pretty outrageous. And they're also skirting the payday lending law by offering registration loans. We've said that over and over again. And we would like to work with the consumer lenders on leveling the playing field for everybody. And right now it's not. It's an unequal. If you have competitors under a different licensing scheme that are allowed to charge up to 204% APR, that's not a level playing field when you are capped at the rates that you're capped at. And so we would very much like to work with you on that at some point. So yes, there certainly are areas where we can continue to have conversations, and $10,000 is not the same as it was, 30 years ago or whatever, it costs more to live. So your point is well taken. And I'm going to say it again, junk insurance fees and all this other stuff that gets added in and bundled into these small consumer lending loans, that's just what it is. It's junk. It's profit for the lenders. And that's a real point of pain for consumer protections. And the higher the loan amount, the lower the interest. It needs to be a tiered and step down interest rate. So, but today we're not talking legislation. Today we are talking law, regulation, enforcement, and reality. And I think that Jamie outlined our position very clearly about that question. If there's follow-up questions looking to the legislative session or whatever, that's a different conversation than the conversation about what the law says currently and why it says what it says and why it needs to be adhered to until otherwise. Does that make sense?
That makes sense. I was just pointing to the comment because yes, we're talking about a law, but also solutions, right? So I think possible solutions.
Could I say something here, which is,
I apologize. I had to leave for 10 o'clock call. Look forward to continuing conversation. For the purposes of the association, we will be limiting our conversations only to Title VI, dealing with the consumer lender law. And so any potential solutions to ensuring that the law that has been touched rarely, twice, both by me on behalf of the association, are modernized to reflect 2025 and beyond versus the vast majority of the statute, which has been in place for decades and has not had any meaningful changes. So we are open to conversations with stakeholders. And I guess with that,
Oh,
Yes,
Thank you, Darcy.
I was just gonna briefly say, we did put that in there, but then when you said in one of your things, I want you to strictly adhere to what we mentioned in the agenda. I took that to be, okay, that's just then what is going on now. And that's a lot different from what Kelly said. And I did try to allude to, so if you're gonna amend, but I thought since you guys had no power to amend, it's just a question about where are we right now? And I wanted to make sure I talked about that. But yeah, I mean, we are certainly interested if there is, and we're interested in hearing that really 10,000 is no longer an adequate definition of what makes for a consumer loan. And for these, it really, from our perspective, is who are the vulnerable borrowers? Who are the people that really can't play the market in any sense? They don't have credit card alternatives to deal with. Those people are the ones that need the protection. And if that amount is no longer correct, then we would be interested in working with that. But that's the places that have done that. Then that's my point about these caps. The ones already in existence need to be lower, and then the ones going further up need to be even lower as well. That's a ratcheting, and it is because the regulation is to make sure, and it's, in a way, it's not blaming, it's just to make sure that the industry does not take any more dollars than they need to away from vulnerable borrowers.
All right, Jamie, so just wanted to clarify then, I think what we're hearing your position is that we're talking solutions now. Okay, so this was part of the issue here because we did encounter this issue of the dual licensure, and I shouldn't say issue because I know you're saying that you don't think that we should allow dual licensure. However, there's nothing in the statute prohibiting dual licensure. If they qualify for a sales finance company license and they qualify for a consumer lender license, a company can hold both. And there is nothing like on its face wrong with holding both. We can, that's a separate discussion of whether a company is purposely being misleading in their lending. And I don't want to get into this.
Right. No, that was pretty clear. That's the evasion, but right.
Just wanted to point that out. There is nothing right now prohibiting us from doing that. So we have to, if they can provide get both, they are allowed to get both. And again, that's a separate discussion. But what you're ultimately saying, at least on this issue, is willing to raise, for your comment letter, your guys' thoughts are raise that cap from 10,000. And while you're doing that, make the interest rate lower progressively as the loan goes up. So inverse relationship there between the rate and the loan cap is what you're saying.
Kelly, you want to say something?
Yeah, and I'm gonna say, we've had this conversation before at the state legislature a number of years ago. And I would add that there are junk fees and products that are sold and packaged with those loans that increase the amount of the cost of the loan. And since it's Department of Finance and Insurance, so it probably could fall under your purview to look at some of that at some point. Yet again, another issue. But it increases the cost of the loan. The cost to borrow money is increased when you start adding in junk fees and junk products to go with the loan. Of course, I know that anyway. So I'm going to leave it at that. And then the higher the loan amount, the lower the interest rate. So those are two pieces to look at when considering changing any sorts of caps on that 10,000. Do I support changing a cap on 10,000? I have no answer to that question today. The answer to that is it depends. It depends on the legislation. It depends on how it's written. It depends on how much it's going to cost borrowers to borrow that money. It depends on how low the interest rate is relative to the amount of the loan cap that's being raised. This is not a new conversation. It's just another way of coming about getting to that. And getting the Center for Economic Integrity on the record. First off, on the record, the law is as it's written, that should be enforced, period. End of story, for the record. And for the record, if there is legislation, that legislation needs to include fees and junk insurance products and lower interest rates with the higher the loan amount. So that's it. And I would have to see it in order to formally commit the organization in any way, shape, or form. And for the record. Now, if you want to have off the record conversations, I'm happy to have those as well. But for the record, do not support changing the statute until I see what the changes look like.
Okay, well, thank you. I appreciate it. Just wanted to clarify that. And it does look like, because we're doing to move into public comments. I think we might have one member of the public online. Is there any members of the public online that would like to provide any comments?
Yes,
Go ahead, Drew.
thank you. My name is
Introduce
Drew.
yourself.
Yeah.
Thank you.
Thank you. Can you hear me all right?
Yes.
My name is Drew Schaefer. I'm the director at the William E. Morris Institute for Justice. My organization engages in systemic legal advocacy to protect the rights of low-income Arizonans and other Arizonans in historically marginalized communities, including doing work on consumer protection matters. So I've been observing the conversation today and just want to start off the top and say, rules matter. Statutes are not advisory. We started this ad hoc meeting with a reminder from the department that the department does not write the law. The department enforces the law. The department executes the law. We all know that the department's mission includes primarily point one, protect consumers. The additional points also include providing certainty on regulatory matters and being wise stewards of public taxpayer resources. As an attorney who does public interest work exclusively and has spent essentially my entire career doing that kind of work, what we have before us today in Regulatory Bulletin 2025-04 is on its face, and I'm going to just read the background. The first point in the background is the department has become aware, mainly through examinations, that some entities licensed as consumer lenders are also issuing loans above $10,000 that could potentially fall under Arizona's Motor Vehicle Time Sales Disclosure Act without the required license. So we're here today. We've heard a little bit of talk about dual licensing. That's a sort of a different discussion. But the factual background that the department announced, which is under discussion today, is unlicensed lending activity. And, you know, this is not a question of business intent on the part of certain lenders and how a business model can only work if borrowers are able to, at some scale, repay their loans. The department's job to be wise stewards of taxpayer resources is to enforce the law as it's written. So if we have not heard much discussion today about unlicensed lending activity that the department may have become aware of, which led to this regulatory bulletin. So that is a matter of consumer protection. And I'd question whether it is a wise use of public taxpayer resources to create a safe harbor for unlicensed lending activity for a whole nother year through the first part of 2027. Sounds like we have a problem that's been observed and discovered, of which the department's become aware of some certain lending activity that's unlicensed that could hurt consumers. And secondly, just a reminder, that point one of the department's mission to protect consumers includes protecting consumers from confusion, harmful, escalating finance charge rates that associate with secondary motor vehicle transactions. So at this point, I'm going to conclude my remarks. Happy to engage in further discussions on these issues, but I'll just close with the reminder that rules matter and statutes are not advisory. Thank you.
Thank you, Drew. Looks like we have one more member of the public online. Would you like to provide comments, Jean?
Hi there, I'm Jean M. Fox. Can you hear me?
Yes.
Thank
Go ahead.
you. I am an advisor to the Center for Economic Integrity. I live in Prescott. And part of the discussion that I've paid a special attention to is the interplay of car title lending with regulated consumer lending. And I appreciated the comments of Lindmark that you weren't interested in being car title lenders under the sales finance law, that you wanted to solve this problem by just having consumer lender loans be larger. And our monitoring of the car title loan industry and seeing reporting from other states and from the Consumer Financial Protection Bureau about this product. It is a predatory product. It is asset-based lending. It puts borrowers at risk of losing probably their most valuable asset. There are almost no protections in Arizona law. They can have single payment, balloon payment loans, perpetual debt, and borrowers are always at risk of having their transportation repossessed. And while consumer lenders make secured loans to borrowers under the rate caps of the consumer lender law, you are being competed against by lenders who are making both unsecured loans classed as registration loans to borrowers who do not have a clear title, as well as secured loans. And so we have the consumer lender law being undermined in the market by sales finance companies under Title 44. And we think that is harmful to borrowers, it's harmful to competition, and that law should be repealed so that all cash loans made by non-banks to consumers operate under the consumer lender law and not this dual backdoor method of evading the consumer lender rate caps and loan term protections. And I'd be glad to help you with that.
Thank you for your comments, Jane.
Yeah, I think we've definitely taken some time, but I do appreciate the comments. I think ultimately we're here to listen, to collaborate, and while we might have different positions, I think hopefully you guys agree that conversation is better than not having it and people making decisions without opening it up. That's what we're trying to do here. And I think we're absolutely committed to engaging with all the parties, perhaps more on individual basis, because I think at the end of the day, there might be some, I think still there might be some positions that we agree on. Just going off the comments and comments in writing, comments today. So I think we're committed to that, and obviously with Fausto, with everybody within the department, we're open to always having conversations. So feel free to reach out. At the end of the day, I feel there's only been one ask at the end of this meeting, which was to extend the moratorium until July of 27. The department will think about it. And obviously, if whatever we decide, it's going to be some sort of written communication to the public, not just to individuals. So we're just committing to that at this time. And then continuing to work with finding permanent solutions. I think we all agree on that. So thank you for attending. Thank you for the comments. And reach out to continue this conversation, please.